Hello everybody, we are the UNB MQIM 2019 team from the University of New Brunswick, Canada. We are pursuing a master's degree in quantitative investment management. Today we provide a brief summary of our investment strategy. My name is Hojat.
My name is Hirsch.
I'm Xingkai.
I'm Pezhman.
I'm Xingmei.
Before we start, we would like to thank our industry mentors from Westcore as well as our faculty, our academic advisor from the Faculty of Management at the University of New Brunswick. The presentation has been structured such that we will first discuss our investment philosophy. In this section, we will discuss the factors in our model and why we chose them, followed by the portfolio construction, rebalancing, and analysis of our performance. We will then discuss what do we expect from our portfolio and conclusion. Before jumping into our investment philosophy, let's just briefly look into what factor investing is and why we chose it. Factor investing is an investment approach that involves targeting specific drivers of return across asset classes. It is a framework that integrates factor exposure decisions into the portfolio construction process. Factor-based investing can be used to actively position investment portfolios that seek to achieve specific risk and return objectives. A large body of academic research highlights that long-term equity portfolio performance can be explained by factors. There is evidence to suggest that factor investing not only has the potential to outperform market cap weighted benchmark in the long run, but also with a greater risk-adjusted trade-off. Investing in factors can help improve portfolio outcomes, reduce volatility, and enhance diversification. The long list of factors can be broken down into two broad categories, macroeconomic and style. Some of the commonly used macro and style factors are inflation, liquidity, value, size, low volatility, and momentum. In our investment strategy, we use value and momentum as our main factors.
Now I'm going to discuss about the momentum factor. We focus on the momentum factor, which is defined as buying the winning and selling the losing factors, as measured by the performance over the last 12 months. The momentum factor has proved to be robust over the last 200 years. On average, it has delivered a return of 10% or above the market per year, before tax and fees. Over the last 1.5 years, the momentum has been stable, except some crash. Momentum has several advantages, such as potential for high profits over a short period, leveraging the market's volatility to the advantage, and leveraging the emotional decision of other investors.
The second factor used in our investment strategy is value factor. The value factor suggests buying a stock that is relatively less expensive as opposed to a stock that is relatively more expensive. Value investing has been widely discussed since 1930s, but the best known work on the value factor was carried out by Pezhman and French in their 1992 paper, The Cross-Section of Expected Stock Returns. The paper concluded that low price-to-book ratio was the most predictive definition of value. In our analysis, we choose book-to-price, price-to-earnings, and free cash flow as our measurement ratios. As we can see from the graph, over a period of last 40 years, MSCI World Value Weighted Index managed to generate an annualized return of over 14%. In the short term, value factors performance has been cyclical and has generated periods of underperformance. However, from the beginning of 2019 until September 2019, the value factor shows a positive performance.
Given the two factors, the next step was to choose which multi-factor approach to go for. The chart here shows the historical performance of a long-short portfolio of US stocks with value and momentum as the two factors. As we can see from the chart, that the intersectional approach outperformed. So we chose the intersectional approach, which is basically sorting the stocks on the two factors simultaneously.
Now we have the two factors and the approach. We will discuss the portfolio construction process. We first normalize each stock's factor by calculating the Z-score, then assign weight to each factor to get our stock's score. We decide to long the top score and short the low score stocks, and choosing 100 in both long and short. We assign the same weight as Russell 1000 sector weights to the set number of the stock in each sector into our portfolio. We use optimization method to construct by finding the max score constraint to long and short weight all equal to 1, and try to keep our beta equal to 0. Also, we need to consider the constraints based on the rule. We rebalance the portfolio when we suspect that our portfolio might fail to meet the requirement compliance. Another focus of rebalancing was to bring the market beta close to 0. Throughout the investment horizon, we try to stay away from merger and acquisitions. We did this by closing our position in stocks that were undergoing or were hinting at merger and acquisitions.
Coming now to the analysis of our portfolio's performance. We initially started with a negative beta of 0.24, which is reflected in our returns before the first rebalance on December 24. The returns can be seen to be highly volatile prior to this date. Post-rebalance, our portfolio achieved an almost market-neutral position with beta coming down to a negative of 0.05. We can further break up the analysis into two periods, the period ending 2019 and the period beginning 2020. Last quarter of 2019 didn't turn out to be a good quarter for momentum factor as it came down by 5.2% during this period. The impact was reflected in our portfolio too, as the factor was contributing to about 47% of the total risk and 48.15% of the returns. Value, on the other hand, saw a recovery in the beginning of the period. Given that we started trading in mid of November, the factor returns can be seen almost flat during this period. Value factor contributed to only 3% of the total risk. For the period beginning 2020, momentum has been the key. It has been a good year so far for the momentum factor as it outperformed all the other factors. Again, the impact was reflected in our portfolio as we turned from red to green. However, similar wasn't the story with value factor. The factor has been underperforming year to date, pushing our returns low. Our portfolio has been overweight on IT and consumer discretionary, which though have been highly risky, yet have contributed to most of the risk. Since we were underweight on other sectors, we tried to reduce this disparity by investing in other sectors while rebalancing. Forward-looking, we expect that the characteristics of our portfolio will sustain us fundamentally in periods of high uncertainty. This is because value and momentum returns have been found to be strongly negatively correlated with each other. This provides us for a diversified portfolio with stocks that are undervalued and have been winning over the last 1 year.
To sum up, it is not all about selection of the right factors, but also the right selection of approach to model construction. We believe that the intersectional approach to model construction will support us fundamentally, and our portfolio will grow slowly and steadily.
That concludes our presentation. Thanks for watching.